Money is important for both state and the citizen. State needs money to run its affairs, to run the government, to run the executives, and to run the judiciary, as well as for the welfare of the citizens. As well as on the other hand, citizens also need money for running their day-to-day expenses and to lead their lives, etc. However, to impose these taxes, state needs legislature and executive. Legislature legislates the statutes which impose tax. Nature of tax, sources of tax, and the rate of tax are told through imposition of tax in the statutes. And then the next step starts. That next step is that the executive collects that tax and recovers that tax on behalf of state. To achieve this end, taxpayer is allowed to file the returns. Taxpayer file their returns of income tax and their sales tax and their custom and excise. If tax collecting authorities think that there is a default on part of the taxpayer and the returns are not rightly filed, then those returns and the tax liability can be amended by the regulators and the executives, who are actually controlling the tax collection and who is also imposing the tax. If the taxpayer thinks that the regulator conduct is questionable and their liability determination is wrong, in that scenario, taxpayer can file appeals and can go to the superior courts for redressal of its grievance against the regulator which is collecting tax. So, taxes collection is actually a process which starts with the legislation through parliament, and after legislation, taxpayer files the return in accordance with the statutes and the laws, and after filing the returns, if the regulator thinks that the return is wrong, they can also amend that assessment in the return. And if the taxpayer is in default, then the regulator can collect their money through different modes. They can arrest the taxpayer and they can attach the bank accounts of the taxpayer to collect money on behalf of the state.